Every investor, right? We're all on this quest to figure out what makes an investment a really good one. Well, it turns out the map for that journey is written in the Greek alphabet. So how do you actually do it? I mean, when you're looking at a stock or a fund, how can you tell if its awesome performance was just pure dumb luck or if there's genuine skill behind it? How do you even measure the risk you're taking for those returns? Well, the answer starts with just two letters, alpha and beta. Now, I know they sound super academic, but trust me, they're not. They are the fundamental tools we use to measure risk and reward, and they pretty much define the two great philosophies of modern investing. All right, so let's jump right in, and we're going to start with our first tool, beta. Because, before you can even think about reward, you've got to get a real grip on risk. And in the investing world, beta is the go-to for measuring a very specific kind of risk. So what is this thing really? Simply put, beta just measures how much a stock bounces around compared to the overall market, something like the S&P 500. By definition, the market itself has a beta of exactly 1. So beta is basically telling us, hey, if the whole market zigs, how much is this one stock going to zag? To make this super intuitive, let's use an analogy. Picture the entire stock market as this huge, sprawling ocean. The tides going in and out, the big currents, that's the market moving up and down. Beta, then? Well, beta tells you what kind of boat you're in. And this is where that boat analogy really clicks. A stock with a high beta, anything over 1, is like that tiny little canoe. It's going to get tossed around by every single wave. So a stock with a beta of 1.2 is considered 20% more volatile than the market. If the market jumps up 10%, you'd expect that stock to jump 12%. But, and this is so important, it cuts both ways. If the market drops 10%, that little canoe is sinking 12%. On the flip side, a low beta stock is like a massive cruise ship. It's way more stable, just gliding through the waves. Okay, so now we get risk. We have a tool for it. The next obvious question is, all right, how much reward should I expect for taking on all this risk? And for decades, the classic answer came from a model with let's be honest, a very academic-sounding name. That model is the Capital Asset Pricing Model, or CAPM for short. And for a long time, this was the map for investors. Its core idea was actually beautiful in its simplicity. It said that an investment's expected return should be tied directly to the kind of market risk you just can't get rid of, the risk we measure with beta. In other words, you should only get rewarded for taking on the risk that diversification can't save you from. It was an elegant theory, perfect on paper, but as more and more real-world data started piling up over the years, a big problem emerged. What happens when the map you're using to navigate doesn't actually match the real world? The core issue, as this research points out, is that CAPM is basically built on a fantasy. It imagines this perfect world where markets are always efficient and investors, people like us, are always perfectly rational. Come on, we all know the real world is way messier than that, right? So here's the bottom line. CAPM completely ignores human behavior, like everybody panic selling at once or piling into a hot stock. It pretends that beta is some fixed number, when in reality, it can swing all over the place. And it has zero room for other massive real-world risks, like political shocks or environmental disasters. And all these flaws mean there's a big chunk of an investment's returns that CAPM just can't explain, which leads us right to the other side of our story. And this is where our second Greek letter comes into play. If beta is the return you get just for floating along in the market's ocean, what do you call all that performance that the old map, CAPM, can't find? That extra bit of treasure? Well, that's what we call alpha. So alpha is the measure of performance after you've already accounted for the risk. In short, it's the return an investment makes that has nothing to do with what the general market is doing. It's the value that a portfolio manager, through their skill, their research, their strategy, adds to a fund or sometimes subtracts from it. So let's go back to our analogy. If beta is the tide that lifts all the boats, then alpha is the skill of the captain. A great captain can navigate better, find faster currents, avoid the storms, and generate returns that a simple boat just drifting along could never dream of. Alpha is that skill, put into a number. And this illustrates it perfectly. Let's say a fund's risk profile, its beta, suggested that it should have returned 12% for the year. But when the numbers came in, it actually returned 14%. That extra 2%, the part that can't be explained by just taking on market risk, that is its alpha. It's a direct measure of outperformance.
So now we've got our two key tools, beta, which is the market's return, and alpha, the skill-based return. And believe it or not, these two little concepts perfectly define the two dominant competing philosophies in the entire world of investing today.
Okay, so in one corner, you have active investing. These are the alpha hunters. Active managers use their research and their strategy to try and pick specific winners, all with the goal of beating the market. But all that skill and research costs money, which means their fees are higher. And those fees can really eat away at any alpha they might find. Then in the other corner, you have passive investing. The goal here isn't to beat the market, but to just be the market. Passive funds simply try to capture the market's beta by tracking an index for a very, very low fee.
But of course, the industry didn't just stop there. A third path has popped up called smart beta, and you can think of it as a kind of hybrid. These strategies start out passive, like an index fund, but then they tilt the portfolio towards specific factors, like value stocks or high-quality companies, things that have historically shown they can outperform. It's like trying to systematically capture a little slice of alpha, but without the high fees of an active manager. So, which philosophy is actually winning? Well, this chart tells the whole story. Over the last decade, we've seen an absolute earthquake of a shift. For the first time ever, there's now more money in passive funds than in active funds in the US. That low-cost beta-capturing approach has become the dominant force in investing.
Okay, we've defined the terms, we've explored the philosophies. Now let's bring it all back home to the only question that really matters. What does this mean for you?
Ultimately, everything we've talked about boils down to this one simple question. Based on what you believe about how markets work, are you a beta seeker? Someone who's perfectly happy to just capture the market's return at a super low cost? Or are you an alpha hunter? Someone willing to pay more for the chance that a skilled manager can deliver something extra?
And look, there is no single right answer here. There's only the right answer for you. If you believe that markets are mostly efficient and that finding a manager who can consistently beat the market after you pay their fees is incredibly hard, then yeah, the passive beta seeking path makes a whole lot of sense. But the hunt for alpha is compelling for a reason. If you believe that true skill exists, that an expert can find an edge, and you're willing to do the work to find them, then the active path might just be your choice.
And that is the crucial takeaway. Understanding alpha and beta isn't just some academic exercise. It is the absolute foundation for building an investment strategy that is truly yours, one that aligns with your goals, your beliefs, and what you're comfortable with. Because the quest for a good investment always begins with knowing exactly what you're looking for.